Hello everyone, we are from Group 5 and we will present about Adelphia case. Our member consists of Delvya, Eliora, Regine, Sherly, and Sylvia. So without further ado, the next slide will be presented by my friend.
First section, we will discuss about the company background. Adelphia Communication Corporation was one of America's largest cable television company. In 1952, Adelphia was founded in Cartersport, Pennsylvania by brothers John Regas and Gus Regas. Regas Brothers incorporated the company under the name Adelphia, which in Greek language is Adelphoi, that has a meaning of brothers in English. At the first, they bought the cable television franchise for just $300, and after 20 years of developing the franchise, they made a massive decision to begin a rapid merge and acquisition of various cable television companies, and made Adelphia as a public company. Adelphia became one of the most successful in the United States, that reached more than 2 million subscribers. Later, to grow their business, Adelphia began provided various services such as high-speed internet, phone services, and voicemail for business. Adelphia is famous as a family business that commits massive accounting fraud. Adelphia's entire top management and board of direction is held by one family. The members of family management and their relationship are John Regas and Gus Regas as founders as well as CEO and chairman of Adelphia. And then, John Regas has three sons. First, Timothy Regas, that held by position of CFO. Next, there is James Regas as Vice President of Strategic Planning. Next one is Michael Regas as Vice President of Operations, and Peter Vanetis, who is John Regas' son-in-law, as one of Board of Direction member. And at the last, the reason why Adelphia is known as family-run firm. It is company run by family management, which is the majority of Adelphia's voting stock and the majority of Adelphia's board of direction is held by one family, which is Regas family. This condition reflects that Regas family held both the agent and the principal position in Adelphia.
As for management motivation in Adelphia communications fraud case, we will use Chris's theory of fraud triangle. Fraud triangle consists of three elements, which are opportunity, incentive, or pressure, and rationalization. In this case, Adelphia, being a family business and having the persisting employee environment at that time, presented Regas family had the great opportunity to conduct fraud. Regas family had filled in the directing board and had 77 voting rights gone to their hand. Employee environment at that time was not befitting of a corporation, as employees were either blindly loyal, hindered from promotion, or oblivious of the current situation of collusion and corruption done by the family. Regas family also considered Adelphia as their personal piggy bank and thought that their business is of their own, so they had the right to manipulate every aspect of Adelphia, including financial terms. This resulted in moral disengagement and became a rationalization for Regas family to conduct fraud. Regas family was particularly fond of lavish lifestyle. They were also entitled. Supporting their ego and lifestyle had become their incentive or pressure to conduct fraud.
The U.S. Securities and Exchange Commission announced that Adelphia Communications' financial fraud scandal was the most extensive financial frauds for a public company because of several frauds perpetrated by the Regas family and other executives, such as: first, hide $2.3 billion of liabilities in their consolidated financial statement. In March 2002, Adelphia Communications revealed that they are liable for intentionally excluded their bank debt approximately $2.3 billion, including $4 million to buy Adelphia stock from Adelphia's quarter and annual financial statement and included it in unconsolidated affiliates on off-balance sheets conducted by the Regas family and Adelphia's two executives. They made false transactions and documents to make it seem like the company has already paid the debt. It caused the financial statement to have misleading information about the real financial condition of the company, especially about their outstanding debt. Second, uncontrolled self-dealing by the Rodriguez family. For around 4 years, the Rodriguez family already used company's assets for about $100 million to cover their personal expenses, especially luxury items such as $700,000 of golf memberships at Bears Creek in South Carolina, $705,000 for condominium in Colorado, $6,000 for 2 Christmas trees and flew them out to Rodriguez's daughter in New York, $26 million for 3,600 acres of timberland, 17 company cars, and etc. Third, overstated cash flow and revenue. To meet analysts, investors, and Wall Street expectations, some of the Rodriguez family and Adelphia's vice president of finance overstated the company's revenue and cash flow, which are some aspects that is required by Wall Street to evaluate the company. A misstatement of the revenue and cash flow are approximately $500 million from 1999 to 2001 by making false transactions and inflated their subscriber numbers by 4.3% due to decreasing number of subscribers. The decreasing number caused the company's number of subscribers to fall below industry standard and placed Adelphia's position in the cable industry at risk. To help the company, they are not only inflate their subscriber numbers, but also they included their expenses such as service cost expenses to the capital items and make dealings with their suppliers. And the last, manipulate Adelphia's stock to maintain the family's control of the company. Adelphia issued 2 classes of stock, which is Class A and Class B stock. The difference can be seen by the number of votes that each of the class held. For Class A stock, the shareholders will only have 1 vote per stock, while the shareholders who has Class B stock will have 10 votes per stock. Also, only the Class A stock that can be purchased by the public. To rule the company, Rodriguez owns all the Class B stock and 12% of Class A stock, which makes them the majority of votes and has the most number of votes when there are voting in the company, including voting for board of directors. As the result, the family have the highest position of control to the company and they can control it as what they wish.
And now, we will discuss about how the fraud is took place in Delvya. It can be seen how the Rodriguez family's fraud scheme takes and hides Adelphia's money by relying on their private entities such as Buffalo Sabres Hockey, family-owned farm, private car dealership, interior design shop, and other entities. All of these private entities belong to the Rodriguez family, which is used to receive money from Adelphia through fictitious transaction of revenue and expense in which the private partnership does not actually provide goods or services to Adelphia. It was suggested that private dealerships were created to cover the crimes, and Adelphia was regarded as a tool for the self-dealing schemes. Technically, Rodriguez management unites Adelphia fund accounts with family funds that caused Adelphia to use this fund to purchase all of the personal expenditure of Rodriguez family under the guise of corporate projects such as personal loans, real estate transactions, as well as purchases for personal use. In addition, the success of this modus operandi of fraud lies in the income of Adelphia subsidiaries and other businesses centered on one account. They dump all of the bills into one credit account. The Rodriguez family used Adelphia's line of credit for personal purchases and recorded finance in Adelphia through fraudulent transactions aimed at inflating the company's revenue and hiding the debts.
Now we are talking about CPA involved. Deloitte and Touch LLP serve as the independent auditor for Adelphia Communication Corporation for at least 1986 when Adelphia Securities became publicly traded and ended until May 14, 2002 when Deloitte was suspended by Security Exchange Commission as their audit work on Adelphia book for the year December 2001 has been falsified. The most well-known auditors that is involved in this case are Gregory M. Dearlove as Deloitte engagement partner and William Caswell as Deloitte senior manager. In this case, our group decided it as auditor negligence. Security Exchange Commission stated that Deloitte engagement team failure to object some of particular misstatement that permitted Adelphia to engage in certain accounting practice that departed from GAAP. Here are some failures of Deloitte engagement team. First, Deloitte failed to detect the $1.6 billion of Adelphia liability that should be disclosed on its balance sheet and financial statement. Adelphia stated their excuses to Deloitte for excluding $1.6 billion of debt from their balance sheet as it is only the guarantor of Riga's co-borrowers. Adelphia's practice of reclassifying co-borrowing debt is to transform their co-borrowing debt to affiliate payables. This practice acts to conceal their growing co-borrowing debt and let investors think that it is Riga's entities that have been doing affiliate receivable and permitting them to access the capital markets. Second, Deloitte failed to object Adelphia netting of related party payables and receivables. Adelphia improperly netted related party payables and receivables at the end years and presented their net balance on the balance sheet as a line account called related party receivable net, which this practice did not conform to GAAP. Deloitte failed to challenge Adelphia practice in netting and issuance unqualified opinion on their December 2000 financial statement audit report permitted Adelphia to disclose a $3 million net receivable. If Deloitte had taken action to correct Adelphia disclosure, then Adelphia would have reported much more relevant number on their gross related party receivable and gross related party payables. Third, Deloitte failed to object to Adelphia overstatement of its stockholders' equity. On January 24, 2000, Riga's entity acquired Adelphia Class B shares for $375 million, which is said to be paid with available funds. But in fact, the Riga's entity paid nothing and Adelphia accounted them as affiliated receivable from the entity for the purchase price of shares. This affiliated receivable with others affiliated receivable was netted and reduced by fake affiliated payables created by Adelphia reclassification. Actually, Deloitte has recognized that Adelphia presented much greater than normal audit risks, where previously Deloitte has identified that Adelphia management tend to interpret accounting standards aggressively. Adelphia organization and reporting structure are unduly complex. There are significant affiliated entities that cannot be audited. There are substantial debt from unusual sources. Adelphia frequently dispute with Deloitte about accounting, auditing, or report problems. Their material transactions are highly complex that pose difficult substance over form questions. As the result, Security Exchange Commission charged Deloitte in an administrative order with conducting a critical flow audit that failed to detect massive fraud done by Adelphia and certain members of Riga's family.
The aftermaths that occurred because of Adelphia fraud are: first, Adelphia's buying and selling share price decreased from $20.39 on March 2002 to 79 cents on June 2002. So, the shareholders of Adelphia suffered heavy losses because the price fell drastically. Second, John Rigas resigned from his position as CEO on May 15, 2002, after being charged with embezzlement of US $2.3 billion and sentenced 15 years in jail for bank fraud, wire fraud, and securities fraud. Third, on June 3, 2002, Adelphia was officially delisted from the Nasdaq due to the failure to complete the 10K annual report and its share closed at 79 cents. Fourth, Adelphia's company name has become tarnished.
because it was proven to have committed fraud and finally filed for bankruptcy on June 25, 2002.
And the conclusion is, Adelphia accounting fraud is a family business scandal that commit massive fraud in 2002. That proves there was a personal interest of the Regas family. It can be concluded that the management motive in Adelphia fraud is to exaggerate the results of recording expenses and hiding the debts, or which we can say that of balance sheet loans. Adelphia manipulated its financial statement to meet the analysis and investors' expectations. This situation, reflected by Adelphia Communication Corporation, presented that fraud happened because of the incentive or pressure from Regas family's luxury lifestyle, and the greed from executive members in conduct the public fraud and loss of the business ethics should be applied due to the conflict of the interests. Not only that, this fraud happened supported by the negligence, misappropriation of contracts, and failure to detect the fraud by external editors, in which Deloitte was filed to detect the money game and accounting fraud in Adelphia. The auditors were unable to demonstrate the professional complaints and unprofessional skepticism to detect fictitious transactions between Adelphia and the third related party. As the result of this negligence, SEC charged Deloitte in administrative order with conviction, a critically flawed audit that failed to detect and audit the massive fraud done by Adelphia and certain members of Regas family. And in the end of the day, Adelphia was officially delisted from Nasdaq and officially filed bankruptcy in 2002. Actually, as an auditor should be able to detect the fraud that occurs in Adelphia, because there have been many red flags or symptoms that can be seen in Adelphia, such as, first, there is a chronic situation, which in Adelphia, the top management consists of most of Regas family members, which is easy for them to commit fraud because they can collaborate together. Their family founded the company, so there is a rationalization that they may have a justification that they deserve what they took, especially since they also work hard for the company. Second symptoms is the luxury lifestyle, which they have an extravagant lifestyle that beyond the means. As explained before, they buy a lot of luxury properties such as world-class golf course and luxury apartment for their personal use. And the third fact is embezzlement of assets, which Regas family use a lot of Adelphia assets for personal use, like always use company private jet and use Adelphia fund for personal stock buying. Fourth red flag is there is accounting anomalies, which the debt didn't appear as a liability on the company balance sheet because it was hidden in the accounting record of balance sheet affiliates. Therefore, they can meet the analysis expectation and show the stability of the company, especially for attract the investor. And the last red flag is the weak of the internal control on Adelphia, which the fraud happened for a long time. In addition, a lot of fictitious transactions happen in that company, like the Regas family have been make a lot of transactions on behalf of Adelphia for their personal family entities, which this condition indicates that the cash management systems on Adelphia is really weak. So, some solutions or recommendations to prevent and avoid Adelphia fraud case happens again as follows. First, minimize the possible opportunity by setting the significant internal control that exists. Internal control can be done by checking the system by documenting the core document loads and revenue procedures. In addition, it can be also be done by identifying the number of people who look biased if there is a loss that occurs in the company. Second, Adelphia employees should have been checking the supporting documents validity of the personal purchases made by Rega's family. Third, regulations and standards must be clear in regulating the organizational structure as the initial stakes of business development so that the Adelphia case doesn't repeat itself where the top executives are held by only one family. And the last, auditors should audit transactions with third-related parties and affiliated entities. Auditors must check financial statements in detail and make an extension to a private business entity because unconsolidated financial statements do not mean unimportant. There may be substantive information of a material nature, as in the case of Adelphia, counseling support corporate debt to their private entities.
So that's all from our group about Adelphia case, and thank you for your time and your attention today. Goodbye.